Let's say you are all set to invest in the stock market, but you want to make an extra income. This video is just right for you. How can you make an income while investing in stocks? You can do that through options trading. I love options trading. They are a type of financial derivative. It obtains or derives from a stock price or any other security. For instance, futures and credit swaps are financial derivatives. Financial derivatives include various types, such as commodity. Well, it is not really exactly. The idea of financial derivative is obtaining a price from any type of security. Options are what I'm interested in, not others. I love options because they're tools or methods to make an income unlike the others. Some people find the others successful. I think it's great, but not for me. As of now, on my opening screen, I'm using Tesla as an example. Tesla's current price is $233 a share. $233. So, options are derived from stock prices. Strike prices are the prices you think the stock price will reach in the future. In other words, you are betting on a stock's movement. The concept is almost similar to futures trading, but there's no time decay involved in futures. They don't have the Greeks, unlike options trading. I'm using Webull as my broker. Probably you have different brokers, Robinhood, Fidelity, TD Ameritrade, or IBKR. It doesn't really matter because the concept of options trading is the same in a number of ways. The design or UI may be different, but it's not my moment to worry about. This time I am on Webull for a demonstration. Premiums, expiration dates, and strike prices will be the same across all trading platforms. All data is handled and retrieved from CBOE, the Chicago Board of Exchange. All regulated brokers must obtain the data, so there is no difference at all. You can see expiration dates: 1 day, 8 days, 15 days, 22 days, 29 days, and so on. There are more expiration dates on the screen. These dates depend on the Greeks. The Greeks are Delta, Theta, Gamma, and Vega. You can get an idea of the Greeks from my screen. You can see the Greeks there: Delta, Gamma, Theta, and Vega. My favorite expiration date is between 30 to 60 days away from the present date. These are considered the sweet spot to make a consistent income. Let's jump to 36 days. See 36 days later on the screen. I'm going all the way down from the $455 strike price. It can be as low as $5 strike price. At this moment, I'm not trading Tesla options. It's just an example to show you guys. If I were to research on Tesla based on its market structure, event news, and fundamentals, and I have a feeling that Tesla will remain above $200 by the time of expiration date, let's say 36 days later, I'm going back to my screen and find the $200 strike price. Look what I found, the $200 strike price. I'm going to hit it. Remember, I told you that I predicted that Tesla will remain above $200 and I'm selling a put on it. Why would I sell a put? If you buy a put, you think a stock price will fall down. Instead of buying a put, I'm selling it. It means I think the stock price will remain above. It's the opposite. So this time, I want to sell because I want to make a consistent income such as monthly. The exact reason I told you that between 30 and 60 days are the sweet spot is because we want to make a monthly income which is more consistent rather than short-dated options. If you choose short-dated options and a price moves against you, your positions don't have time to adjust and it will be difficult to change immediately. Extended dates, your positions have more time to change if the price moves against you. Longer dates allow you to collect better premiums. Let's click to sell the option. I clicked on it. You can see the table at the bottom. See the expiration date, the 16th of February, which is 36 days later. Here it is, the $200 strike price. One quantity or contract equals 100 shares. It's because options are leveraged. Now here this part is very important. Whenever you place an options order with any broker you use, make sure you click limit order, not market order. Why place a limit order? You know, a normal stock you usually purchase, you can choose a market order because stocks are highly liquidity and usually have tight spreads, which means bid and ask prices will be close to the fair price. More people are trading in stocks. There are not many people trading options, so option spreads are often wide. Therefore, you're likely to fill in options at the wrong price. So you want to use limit order and place a price close to the middle price. Now you can see $2.68 on the screen. Does that mean you're getting $2.68? Not exactly. Remember, I told you that options contract equals 100 shares. Let's do math. 100 shares multiply $2.68. How much is that? It's $268. Let me show you how to calculate. You can see the answer at 268. It's super easy to calculate. 36 days later, if the price remains above $200, you collect $268 in a month. That's nice for your monthly income. The income isn't guaranteed. You can lose money if the price falls below $200 by the expiration date. You want the price to remain above $200. I showed you the table. Now I'm showing you a graph. The graph can give you an idea of price movement on expiration day. If Tesla's price is $225 on the expiration day, you get to keep the premium. P&L, profits and losses. The profit is $268. Let's move the price down a bit to see if it profits or loses. I'm showing you. You can see $202 and it's still a profit. When it falls below $200, you lose money. If Tesla goes to $187, you lose $954. I'm sure you get it now. Here's this part. You may panic, but don't worry. This is just to remind you. You'll probably see a max loss warning somewhere on your trading screen like this. You can see $19,732 right there. It's normal. Max loss tells you how much you could lose maximum if the company, given Tesla as an example, goes bankrupt. The stock price plunges to zero, and the loss will be $19,732 under this contract. How does it know the loss? Okay, remember, I set the $200 as a strike price. Now, $200 multiplies by 100 shares. The answer is $20,000. Let me show you how to calculate. Here it is, $20,000. Now, why $19,732? It's $20,000 subtracting $268. It already placed the $268 order. It's a credit under the contract. Selling options are credits, not debits. Debits are for buying options. Let's subtract $20,000 and $268. It's $19,732. It matches my answer. I'm doing very well in math. My math isn't a lie. I wanted to show you how true math is. The rule when selling options, especially puts, make sure you pick a strike price that you would gladly purchase if a stock price goes under the strike price. Let's say Tesla's current price is $233. You pick the $200 strike price because you don't mind buying 100 shares at $200 if Tesla goes under $200. It's important that you sell at the strike price that you don't mind buying and owning 100 shares of the underlying stock. Don't sell put options if you don't want to own them. You probably noticed that some people mention cash-secured puts. It's similar to selling puts. This goes the same for short puts. They are all the same, just different words. So don't confuse yourself with those different words. When I was a newbie to options, I was confused by them. It wasn't until later that I realized they were the same. I want you to understand that those words are different from naked puts. Naked puts are extremely risky. I know most brokers don't allow naked puts unless you have experience. There are certain levels you have to pass before doing naked puts. I believe it's for level 5. Robinhood doesn't do that. Fidelity and other brokers for advanced users have that. But don't do that. When you sell calls, you will see a covered calls. It's similar to short calls as well. Remember what I told you about selling puts. You think a stock price will remain above when selling puts. Vice versa for selling calls. You think a stock price will remain below. Let's go with the same expiration date. 36 days. It's easier. You have a feeling that Tesla will stay below $300. You go ahead and pick a strike price of $300. You change the section from puts to calls. I'll click on the $300 strike price and sell a call. You can see $1.05 on the screen. It equals $105. Let's calculate again. You see the answer, $105. 36 days later, if Tesla stays below the $300 strike price, you keep $105 the premium. It's nice to keep the premium for a month. Selling covered calls require you to own 100 shares of the underlying stock that you can sell. If you don't have 100 shares of the underlying stock, Tesla, you can't sell call options. It's why it's called a covered call. It's because you own stock to cover your call. You want to sell a call because you don't mind selling 100 shares of Tesla if it goes above $300. I'm sure many of you have jobs or own businesses. You make income from them and invest it into Roth IRA or personal investment account. They grow eventually, but you want extra income. You can use and sell options to make monthly income. You want it to be consistent, not short-term. Short-term may offer higher returns, but that's not how it works because of the Sharpe ratio. If you study the Sharpe ratio, you will understand why higher returns are not sustainable. It's about being steady, slow, and consistent. You earn money from your job or business plus investments and dividends from stocks. It's nice to have those incomes. I plan to make more videos about options. Keep an eye on them. Smash the subscribe button and you will get notifications every time I publish videos on any topics or options that you have to know. Subscribe and you will get them from me. You can ask questions by leaving comments below. I can answer and summarize your questions. And lastly, make sure to like this video for YouTube algorithm. See you next time, soon.